Utilizing a Roth IRA properly, especially if you're a high income earner, can transform your financial situation. It can provide you with that key ingredient to retire early and be eligible for free retiree health insurance. Can even be the difference between you having enough money or coming up short from taxes taking a large bite out of your retirement. Today, I'm going to share with you what a backdoor Roth IRA is, how to do one properly, and if you stick around to the end, I'm going to go in depth on two benefits of the backdoor Roth that no one talks about, that in my experience are incredibly powerful for a retiree. Hey everyone, I'm Ryan Page, certified financial planner, and I'm here to teach you how to optimize your financial situation so you can live the life you've always dreamed of. Roth IRAs are one of my favorite investment vehicles because they have so many amazing benefits. The problem with the Roth is, what if you're a high income earner? The IRS doesn't allow you to contribute to a Roth IRA if you make above a certain income level. But there's a way around this rule, and that's where the backdoor Roth IRA comes in. It can be a strategy to fund a Roth IRA while avoiding the income limitations imposed on making a Roth contribution the normal way. Now, I do want to warn you, there are many factors and rules that must be considered and complicated steps to properly implement this strategy without penalty. Therefore, I recommend staying tuned and even replay this video to get a good feel for how this is done. First, there are 3 steps to determine if you're eligible to make a backdoor Roth IRA contribution. The first step is, do you or your spouse have income from a job or self-employment? If you don't, you can't contribute. For the second step, you need to determine if your income is above the modified adjusted gross income threshold, or MAGI for short. If it's not, you can stop and just contribute to a Roth IRA the traditional way. In the description below, I've included the tax tables for the current tax year so you can see if you're above or below that income phase-out threshold. And I know some of you may be wondering, what in the world is MAGI? Now, MAGI is calculated by taking your AGI, which is typically line 11 of your 1040 tax return. You add tax-exempt interest and other deductions. If you go to the irs.gov, they have a 7-step worksheet you can fill out to precisely calculate it. I also like to use a quick test to get a rough approximation by totaling all income sources. We then subtract 401k contributions, similar retirement plan contributions, health savings account contributions, and health insurance premiums paid as an employee. If that result is within 10,000 of the limit, it's best to use the IRS worksheet. For the third step, you need to confirm that you have a $0 account balance in existing traditional IRAs, SEP IRAs, and simple IRAs. A balance in an inherited IRA is okay, and a balance in a spouse's IRA is okay, so long as that spouse does not contribute too. Now, don't worry if you do have an existing IRA with a balance. There are steps you can take to make a backdoor Roth IRA, which I will cover later in this video. Now that we've determined whether you're eligible or not, we can move on to the actual steps to completing a backdoor Roth IRA contribution. The first step is you need to open a traditional IRA if you haven't already done that, and you need to make a non-deductible IRA contribution. There's a dollar limit on the amount of that non-deductible contribution, which I've included the current tax year limit in the description of this video. Also keep in mind that you cannot contribute more than your household income earned from working. So if you earn $0, but your spouse earned $10,000 for the year from part-time work, you can contribute to a backdoor Roth IRA so long as the most you contribute is a combined $10,000. For the next step, you'll convert that IRA into a Roth IRA by completing a Roth conversion the next day. At this point, you might be thinking, well, I thought a Roth conversion causes tax consequences. And yes, normally that is the case. But in this particular situation, we made an after tax contribution to an IRA, which allows us to convert that money to a Roth IRA via a Roth conversion without any taxes due. I will also say for this step, some professionals do recommend waiting a month or longer to convert because of what's called the step transaction doctrine. Now, the IRS hasn't issued any specific guidance on this in the many years I've been doing these, and therefore I like to do the Roth conversion the next day. Also, don't forget to invest the funds after the Roth conversion is complete, according to your goals and objectives. I've seen many of times someone completes a backdoor Roth IRA, but then forgets to invest the funds, which defeats the point of the Roth. For the final step, you just need to file tax form 8606, and if both spouses contribute, then you each need to file that form. The actual process seems simple enough, right? Fund a traditional IRA with a non-deductible contribution, convert it to Roth, and then file an extra tax form, or if you're married too. The tricky part is just making sure you follow all those nuanced rules. Now, to circle back to the eligibility step that I mentioned earlier regarding having a $0 balance in IRAs, I'm going to use an example to showcase what can go wrong and also how to fix it. So let's say Mary's a physician earning $300,000 and wants to make a backdoor Roth IRA contribution of say $5,000 for simple math. She opens a new traditional IRA and makes a non-deductible contribution of $5,000. She also has an IRA with a balance of $95,000. Mary decides to convert that $5,000 in the non-deductible traditional IRA, but unfortunately the IRS doesn't see it that way because of what's called account aggregation and pro rata rules. The IRS views the 5,000 conversion as 95% taxable and only 5% non-taxable in this instance, the pro rata part, because the IRS looks at all IRA balances, aka aggregation, which in this case total 100,000. Mary wanted to contribute 5,000 to a Roth IRA tax-free, but in the process actually caused tax on 95% of it. Not what she intended. Now, fortunately, there's two potential solutions to avoid the aggregation and pro rata rules. One potential option is to do what's called a 401k roll-in, where you take IRA money, you put it in a current 401k plan. Once it's in that 401k, it's not included in the testing. Now, the second option, and maybe the better option in my opinion, is to open up a solo 401k where you roll IRA money into that. I like this option better because the investment options are generally significantly better in a solo 401k as opposed to an employer provided 401k. The downside is you either have to be self employed or open up a legitimate business to be able to open a solo. And today there are so many options to open up and own your own business, whether it's a lawn care business, a consulting firm, or even driving for a rideshare company. So I'd like to at least mention this. Now, on to the exciting part that I promised earlier. What are the two benefits of a Roth IRA that no one seems to talk about? Well, if you've done any reading on Roth IRAs before, you probably already know they offer tax-free growth, tax-free distributions, no required minimum distributions, and potentially lower taxation on Social Security benefits compared to other retirement accounts. My favorite two benefits are number one, create generational wealth. In my opinion, there is no better investment vehicle to pass to your heirs than a Roth IRA, because not only does the entire account pass tax-free, but your beneficiaries get an extra 10 years of tax-free growth after you die. Just imagine for a moment on the day you pass that you have a balance of 1 million in a Roth IRA. Using the rule of 72 and assuming a 7.2% rate of return, your beneficiaries would receive not just the 1 million, but an extra 1 million of tax-free growth over a 10-year period. If that doesn't motivate you to do a Roth IRA or backdoor Roth to create family wealth, I don't know what will. Now, number two, and probably my favorite benefit of the Roth, is for those looking to retire before age 65. Roth IRAs can be used to help qualify someone for free or low cost health insurance through the healthcare.gov marketplace. I have saved some of my clients $20,000 or more per year of health insurance expenses in early retirement by using a Roth IRA because the healthcare.gov marketplace is an income test, not an asset test. I once had a case where the household net worth exceeded 5 million. They got free health insurance because we controlled taxable income using a Roth IRA distribution strategy. And hint, Roth IRA distributions never show up on your tax return. Income test passed and free health insurance to them, at least to get them through early retirement until Medicare age of 65. Now, I hope you found today's video helpful and learned something new. I'm grateful for you and wish you the very best in your financial journey.